Hey, everybody, it's Adam Tracy, and you see a lot of inquiries, and you also see a lot of like marketing online about starting a proprietary trading firm, right? And there's a ton of misinformation, right, about how you do it, both from a mechanical, like operations standpoint and a compliance standpoint. So, at its core, a proprietary trading firm is just a firm that trades with its own capital. Right. So when you're starting one, okay, and like we'll do this as a series, right? And this will be tr- Prop Firms 101, the basics, right? The primary concept that you need to adhere to is trading your own capital, right? And the reason being, if you are like accepting investor funds, then you start to trigger different registration requirements. So if you are accepting third-party investor funds for trading equities, well, you may trigger SEC, FINRA, broker-dealer registration requirements. If you're pooling funds to trade commodities, then you're looking at either CTA, CPO, and IB registration requirements, right? Same with Forex. Crypto, you're kind of in a gray area, but you could even fall into the sort of payment side, the compliance side of having to register as an MSB, right? And then on top of all of it, depending on how large you are, then you get into the requirements of registering as an investment advisor or as an investment company under the Investment Company Act, so forth. So that's number one, trade with your own money. Number two, there's two models for a prop firm, right? There's just the traditional model where traders come in, they go through some sort of training, or they have certain level of experience. They're hired like almost like they're applying for a job, and they trade the firm's money with a profit split, right? Typically 70-30, 70 to the trader, 30 to the firm. But the more common thing that you see online is let's call it the evaluation model, where the trader has to pay X amount to enter into like an evaluation in a simulated trading environment. And if he or she passes or meets some score that's acceptable to the firm, then they get access to the funded account. But there's an issue with that because the SEC and some states now have looked at the evaluation model as being itself a security, right? Because if you think about it, I'm paying money, okay? I am receiving a benefit from it. There is the potential of a common enterprise, right? So I'm mimicking Howey, the Howey test. And my reward, right, is a share of the profit, okay? And that's predicated upon me paying the $500 or whatever it is to basically do this test, okay? So when you are in the very traditional model of like, we have our own capital, we'll hire our own people, no evaluation, no payment, then you're fine. But if you're doing the evaluation model, calling it a profit share when people get to the funded account level, right, isn't the way to go. Because, again, they paid to get in, okay? Now they're going to get, conceivably, if they're successful, some sort of profit return. So conceptually, right, what we want to do is stay away from that language in the evaluation model and call it something different, right? And pay them differently. So typically like bonus, performance incentive, what have you, but try to uncouple, right, the like strict profit sharing language, meaning like 70% of the profits earned. Try to make it, if you reach a certain threshold in terms of profit, it entitles you to receive a bonus or payment of X, right? So like decouple the percentage, right? That's like the key concept there. And that's where you see a lot of these proprietary trading firms, which all pop up like overnight. They have no compliance. They have no corporate structure. They have all, and that's like crazy. It's the worst way to do it because it's not an expensive endeavor to set these things up. And so outside of what capital you put into it, so which brings me to my third point, document, right? You cannot just do this by the seat of your pants. Like you have to have agreements in place. And it ranges from just basic like trader agreements to risk disclosures, and tax issues. Because at the end of the day, you have to make the decision. Do I want these traders to be employees? Are they independent contractors? And you have to adhere to those fictions, those legal fictions of what they are, and those are going to be governed by documents. So, one, you'll have your basic like trader agreement, like a risk disclosure that you should have them sign, a statement regarding capital allocation and margin, things like that, right? And then finally a termination and clawback type agreement, because you can't let them just like run if they have a bad day and you have them paid out. You want to be able to claw back profits that were not distributed should they not perform, right? Or should they lose subsequent to that and then just like leave the firm. And there's probably 20 other disclosures that you need, but in the absence thereof, you see some regulatory, cases out there where I look at them and I say, okay, well, really the problem was more so the fact that they didn't really define what they were doing. They didn't really define what the trader's role within the proprietary firm was. They didn't define how people were really getting paid. It was just sort of like this amorphous, sort of thing. And that could be like the death knell, even if you're doing it right, because at the end of the day, all you need is one aggrieved trader who, lost money or took the evaluation, didn't pass, whatever the case may be, and it goes up the ladder, right? And the funny thing is, more of these type enforcement actions come from the FTC than CFTC, SEC, anything like that, because they're looking into false and misleading advertising regarding evaluation prop firms, right? Valuation-based prop firms. So like very, very clear marketing, and that will be the subject of a subsequent video. But the basics, right? Trade with your own money, okay, to avoid, registration, licensing requirements. Define what you are, a traditional prop firm, and if you're an evaluation firm, be wary of how you classify trader compensation, right? Staying away from profit split and like language. And then finally, document it. Document everything, just like it's a real business, because surprise, it's a real business. So that is starting a prop firm 101, volume 1. I'll follow this up with some more intricate elements and different concepts in a subsequent video over the next few days here this week. And in the meantime, if you have any questions, you know where to find me, adamtracy.io. Hit follow, subscribe, whatever we do on YouTube, and I'll talk to you next time. Cheers.